In today's episode, we'll break down two important stories. First, we'll talk about an almost good quarter for Reliance, and then we'll talk about the time the gas markets broke. Welcome back to the Daily Brief by Zerodha, where we cut through the noise to help you understand what's actually happening in the most important stories from business and markets. I'm your host Akshara, and today is Tuesday, 28th April. Coming to the first story. So Reliance, India's biggest company, released its results last week. For anyone that wants a quick snapshot of the economy, Reliance is a quick, dirty way of checking its pulse because of how much the economy it touches. From the fuel in your car, to the data on your phone, to the groceries you might cook with, it's hard to go a day without bumping into something Reliance sells. For most of last year, the company's results looked brilliant. And then March hit. West Asia erupted in war and the company's fate changed. Its largest and oldest revenue-generating segment, that is oil to chemicals or O2C, took a massive hit this quarter because of the war. That alone was enough to pull down the company's profitability. But still, it wasn't a terrible quarter. The company's revenue actually rose 13% to rupees 3.25 lakh crore. It couldn't earn profits at nearly the same rate though. Its EBITDA, the money it generates from core operations, fell marginally while net profit fell 9%. That's unusual, isn't it? Why did the company's revenue go up while its profits went down? That too traces itself to the Hormuz crisis. So when oil prices spiked after the Strait of Hormuz was effectively blocked in March, the products Reliance sells became more expensive, pushing revenue up. But the cost of everything that goes into making those products, like crude oil, shipping, insurance, spiked even harder, eating into margins. That's the story of this quarter. So Reliance operates one of the world's largest refinery complexes at Jamnagar, and it normally sources nearly half of its crude oil from the Middle East. But when the strait was blocked, that stopped being an option. From 20 million barrels a day, the amount of oil flowing out of the region fell to 4 million barrels. Prices went wild, and Dubai crude hit $168 a barrel. Then Qatar Energy declared force majeure on its entire 77 million ton LNG operation after its units were struck. Suddenly, Reliance had to scramble. But the company had a secret trump card. The Jamnagar refinery could work with any feedstock, and it could process over 200 grades of crudes, and it put that ability to work, sourcing crude from Venezuela, Russia, Brazil, and Mexico. Of course, flexibility alone wasn't enough to completely replace supplies, given the sheer scale of the disruption the company faced. Its throughput, as a result, fell by 4%. Meanwhile, the barrels they did process came at enormous costs. Each barrel could cost a premium of as much as $40 above the benchmark. Freight rates too surged to 10 to 15 times normal, and insurance on tankers went from thousands to millions of dollars. If you didn't know any better, you'd think this would have been a historic quarter. After all, gas oil cracks, or the difference between their raw material or crude and their output or gas oil, was at $35.4 per barrel. That was up 148% year on year. Only this wasn't the sort of environment where one could actually capture those margins. The real cost of crude was far above the benchmark that cracks are measured against. On top of all that, three other things hit margins. First, domestic fuel prices haven't been raised. GOPP found themselves selling petrol and diesel at government control prices even when they were themselves buying crude at $168. Their volumes grew 27% over this period, which in normal times would be great, but at a time like this, it just deepened the loss on every liter. Second, the government brought back the special additional excise duty on diesel exports, effective March 27th. And this was a tax on the sorts of windfall profits Indian refiners earned in the early years of the Ukraine war. This had been wound down to zero, but it was now revived because export margins, at least on paper, looked enormous. Third, Reliance diverted propane and butane from its petrochemical operations to make domestic LPG, quadrupling supply because India couldn't import LPG through the strait. That is a national service obligation, but it directly hit their downstream chemical output. Now, all of this meant that ultimately Reliance's O2C EBITDA fell 3.7%. You can read that as either disappointing or remarkably resilient, depending on how you expected them to handle the current state of the world. Now, this was upstream. Downstream, the chemicals picture was equally rough. Take plastics. The Middle East accounts for 13% of the world's ethylene capacity, which is the main raw material that goes into making plastics. And it also supplies a quarter of the world's commodity chemicals. Asia's entire petrochemicals industry is married to the region's supply chains, and as those broke, cracks across Asia slashed utilization from 80% to 50 to 60%. Reliance, thankfully, was relatively insulated from this trend. 75% of its ethylene comes from US ethane and not naphtha. But its polymer margins were still weak as PVC demand fell 10%. But the concern isn't Reliance's financials specifically. Those chemicals directly touch important parts of the economy, and the company's management flagged something that goes well beyond its own P&L. In its words, the biggest impact has been on methanol, which hit the fertilizer sector. That is a dangerous development. If it persists into the Kharif season, we might soon be asking questions around food security. And there was a final hit Reliance took. Its upstream KG-D6 gas field, the deepwater block off India's east coast, saw its EBITDA fall 18% as volumes declined from natural reservoir depletion. Meanwhile, the government redirected gas to priority sectors during the crisis, capping the prices they could charge. So, the good thing about being a conglomerate, though, is that your other businesses can make up for a nightmare quarter in one segment. One of those was telecom. Jio ended Q4 with 524 million subscribers, 268 million of whom were on 5G alone. And that pushed its revenue up 11%, while its EBITDA was up 16% with good margin expansion. That's remarkable given that there wasn't even a tariff hike this year. People were simply spending more on its services. The company's average revenue per user or ARPU grew 4% to rupees 214 purely from people upgrading plans and consuming more data, which hit 42.3 gigabyte per capita per month. Now, this expansion was driven in part by home internet connections. Jio now has 27 million fixed broadband connections, and AirFiber, which uses the 5G network to deliver home internet without laying fiber, drove 75% of those additions. As the company claimed, it added 25,000 to 30,000 and sometimes as many as 50 to 60,000 homes every single day. But there's a catch to those headline numbers. Jio bought its 5G spectrum back in 2022. But the costs of that purchase, the installment payments, the wear and tear charges on the network equipment, only start showing up in the books once the network is fully up and running. That's happening now. Those costs are all hitting Reliance's books. So even though Jio's core business grew EBITDA 18% for the year, its actual profit grew only 13%. That gap between the two is the cost of having built a 5G network. And it's not going away anytime soon. Reliance Retail posted a record Q4 revenue at roughly rupees 98,000 crore. This was up 11% from last year or 14% once you adjust for its FMCG business being demerged into a separate entity. But interestingly, the EBITDA margin fell to 7.9% from 8.5% a year ago. Reliance has been aggressively scaling hyperlocal delivery, and its orders from the segment grew 300% year on year. But that kind of rapid build-out costs money. The more you grow such a business in the short term, the more it drags on overall margins. Now, Reliance's quick commerce model is fundamentally different from the likes of Blinkit and Zepto. It doesn't build dedicated dark stores. It turns its 20,000 plus existing retail stores into delivery hubs. Meanwhile, its 682 electronic stores and 1,700 plus fashion stores now offer 2-hour delivery. So they aren't selling from a dark store with a few hundred SKUs, but from actual Reliance Digital and Trend stores carrying thousands of products. On the FMCG side, meanwhile, RCPL posted Rs 22,000 crore in FY26 revenue, roughly double the prior year. The sector's champion was Campa Cola. The drinks brand earned Rs 4,700 crore in these 3 months, making it India's 4th largest carbonated soft drink brand. Now, we've written about the Campa story before, and in all, the company's overall beverages category exceeded Rs 6,000 crore. Coming to Reliance's media business that hit 550 million monthly active users in March. This was led by marquee cricketing events, and during the T20 World Cup, Jio Hotstar broke the global concurrent streaming record at 72.5 million simultaneous viewers. The IPL 2026 opening weekend, meanwhile, was the largest ever. Arguably, though, none of this beat its media arm's biggest success, Dhurandhar. The franchise crossed Rs 3,000 crore worldwide, with both films topping Rs 1,000 crore each. This arguably makes Geo Studios India's largest content studio. In all, on the content side, the company's Q4 media revenue was rupees 8,372 crore. And this was led by digital ad revenue, which hit a record, though TV entertainment ad revenue stayed weak from FMCG spend cuts. Now, if there's one tricky corner of Reliance's portfolio, it's the new energy vertical. So in October 2025, management said polysilicon commissioning was 1 to 2 quarters away. In January 2026, they said all factories, polysilicon, ingot, wafer, glass, would be commissioned during the current year. That timeline, though, appears to be slipping. In April 2026, after FY26 has ended, they're still targeting the next few quarters. Now, this isn't to say the company has nothing to show. It already has lines for solar PV modules and cells are done. But upstream integration, the key that makes this a fully self sufficient solar manufacturing operation, is not. The company has plans that will stretch for years, and it's setting up battery manufacturing targeting 100 gigawatt with a 40 gigawatt first phase. Its Samsung CNT green ammonia contract, a massive $3 billion deal for 15 years, will start in 2029. But that's 3 years away. With a pattern of mixed timelines, it's hard to know how to assess these plans. Now, there are many benefits to being India's largest company. And one of them is that no matter what the world looks like, some parts of your business will always thrive. This time around, it's Reliance's consumer business. Geo, retail, FMCG, that are all growing well. More than 55% of the company's EBITDA now comes from these businesses. In a quarter where the energy side was getting hammered from every direction, they held the whole thing together. But that doesn't take away from the company's concerns. O2C is still its single largest revenue segment. It's an industry with national importance. After all, India still imports over 85% of its crude. Even if all its businesses have a standout quarter, this one segment still looms large for Reliance's fortunes. We go through tons of investor presentations and reports while researching our stories. So we thought, why not compile the best infographics, charts, tables, and slides into one newsletter? That's exactly what we do in Points and Figures, a weekly newsletter we send out every Tuesday. Link is in the description. Coming to the second story. We've been covering reports from the International Energy Agency for a while here at the Daily Brief. These used to be rather unexciting as things went. A few countries were seeing their demands rise, others were investing in supply, and this would all become relevant perhaps 10 years from now as these forces collided at their glacial pace. But we never thought these reports could become the site of intense drama. But that's the world we live in now. The IEA just released its gas market report for this quarter, and it's a picture of chaos. The West Asian war has thrown the world's energy markets into a topsy turvy spin. All assumptions are now off. All projections have been torn asunder. Before the war, the world expected to see a massive LNG wave. Fundamentals alone were supposed to push countries to massively ramp up how much natural gas they used. That story is now effectively dead, at least for the next couple of years, if not longer. Instead, the big question is, how long must we wait before we can start rebuilding? Now, to understand just how wrong things have gone, you need to see how different we thought things would be going in. 3 years after Russia's invasion of Ukraine had sent prices skyrocketing, the world's gas markets were finally making a recovery. Supply was finally catching up with demand, prices were settling down through the second half of 2025 and into 2026. New liquefied natural gas plants were coming online one after another. Last year, the United States opened a new liquefaction and export terminal in Plaquemines in Louisiana. Soon afterwards, LNG Canada began production out of two new LNG export terminals on Canada's west coast. Then, in February this year, America's Corpus Christi export facility in Texas saw a massive expansion. The gas was well and truly beginning to flow. Some of these projects were massive. Nearly half of all the new LNG that arrived on global markets between October and February came from the Plaquemines plant alone. This expansion was pulling prices down, and by early 2026, European gas was trading roughly a quarter cheaper than the year before. Asian prices had fallen even more. As prices came under control, demand followed. After years of suppression, a response to the crisis that the Ukraine war kicked off, gas use was creeping up across Asia. Europe too was returning to natural gas. By the winter of 2025, LNG made for over 40% of all the gas the continent burned, up from a third the year before. The IEA back then had projected that global gas demand would grow by 2% across 2026. This, it seemed, foretold a coming wave. Enormous new projects would keep coming up in the coming years. Qatar alone would add 70 billion cubic meters of new capacity. Buyers across Asia and Europe were waiting to absorb this capacity, and India was one of them. We had been short of cheap LNG for many years by this point. Indian industry had been quietly switching out of gas, moving to naphtha, fuel oil, even diesel because gas had become too expensive. But the drought was getting over and we would soon join the market. Then the wave broke. The Strait of Hormuz effectively closed on March 2nd, and we've probably talked about those 33 kilometers more than any geographical feature on Earth. The same thin sliver of water was also the main route for all the natural gas exports coming out of Qatar and UAE, which together were responsible for roughly a fifth of all the LNG sold on the planet. When the strait closed, the floor fell off the bottom of that supply. Prices shot up instantly. By March, gas in Europe was trading at $18 per million British thermal units, the highest monthly average since the worst of the Ukraine war. In Asia, spot prices climbed to nearly $21, nearly twice the $11 industrial users were paying under long term contracts. If you had made your plans based on those long term prices, they were effectively ruined. Meanwhile, the volatility in the markets went wild. According to the IEA, European gas markets were swinging at their most disorderly pace since autumn 2023. In Asia, the last time they'd been this wild was the chaos of early 2022 in the very first weeks of Russia's invasion. As one supply route was choked, all the markets that relied on it, India, Pakistan, China, Bangladesh, scrambled for alternatives. Those lost cargoes, after all, had to come from elsewhere. Indian buyers ended up sourcing roughly thrice as much LNG from North America in March as they had just a year ago. From West Africa, they bought more than 6 times as much. Every ship from those distant ports, meanwhile, had to travel much farther. This pushed up shipping costs. Rates for LNG carriers roughly tripled in early March, the steepest day on day jump on record. Different countries were differently positioned to absorb the damage. China's LNG imports, for instance, fell by one third, India's by a sixth. Meanwhile, Pakistan, which relied on Qatar for nearly all of its LNG, saw imports collapse by around 70%. Everyone relying on that gas, power plants, fertilizer factories, even entire industrial estates, was suddenly shuttered. The ceasefire has done little to quell the issue. The strait is still not open. Iran is now charging tolls of more than $1 million per ship, while the United States has imposed a counter blockade on Iranian ports. The hot war may have cooled, but the chokehold on global energy has not. Now, Ras Laffan is the world's largest LNG export terminal, and it has 14 liquefaction trains, which are the giant industrial systems that take natural gas, supercool it until it's liquid, and load it onto ships. On the night of 18th March, two of those trains were damaged in Iranian missile strikes. Qatar supplies roughly a sixth of the world's LNG. With those drone attacks, almost a fifth of that capacity was destroyed. According to Qatar Energy, the repairs will take 3 to 5 years. It's hard to rush this. The equipment that goes into an LNG plant is enormously specialized, and you can't order a replacement gas turbine off the shelf. Before the war, Qatar had been preparing the largest expansion of LNG capacity in the country's history, a project called North Field East with 44 billion cubic meters a year of new capacity. It was scheduled to start coming online in the second half of this year, but construction has been suspended for now, and that timeline has slipped by more than a year. A second project, Northfield South, was supposed to follow in 2028, and there are no longer any public timelines for it. All of this is to say, even if the war stops today and the strait opens immediately, the gas market won't simply return to normal. When you add up all the damage of the war, the damaged units, the lost production, the delayed expansions, the IEA estimates that the war effectively destroyed around 120 billion cubic meters of LNG supply between 2026 and 2030. Roughly 15% of the new LNG the world had been anticipating as part of the supposed LNG wave is now gone. And the IEA frames this tactfully. The crisis to them has delayed the LNG wave by 2 years. The reality, arguably, is that any medium term energy outlook has simply broken down. The wave was based on an assumption that there would be enough new LNG by the end of this decade that it would finally be enough for the developing world to leap ahead. That world may well be outside our reach. Now, the Hormuz crisis may have sent gas prices up across the world, but it didn't affect the whole world in the same way. The countries that were most dependent on supplies from the Persian Gulf were those that, when the strait was shut, were hit hardest. India, for instance, sourced nearly 30% of all its gas and 60% of its total imports through the Strait of Hormuz. Others in our neighborhood were struck even worse. Pakistan, for instance, imported all its LNG from Qatar alone. Bangladesh imported about 60% of its LNG via the strait. Europe, in contrast, got less than 3% of its gas from the strait. Now, this asymmetry was why the crisis was felt the most deeply in our corner of the world. India's largest LNG buyers, Petronet, GAIL, get most of their gas through long term contracts with Qatar. Once that supply was frustrated, our only option was to shift to the spot market. And here, the prices were 3 or 4 times what we had paid under existing contracts. We were big enough to matter, exposed enough to feel the shock, and yet we lacked the ability to simply absorb high prices. We couldn't simply buy out the supply in other markets. The price was too high to clear, and our only option was to manage the chaos. And that's what we did. In early March, the government invoked the Essential Commodities Act of 1955, a law most commonly applied for food shortages to ration gas. With this, while some users were still allowed unrestricted access to gas, others saw their quotas chopped. Industrial users, for instance, saw their gas supply fall by 10 to 30%. Our gas markets had been liberalizing for the better part of 2 decades. But the crisis sent us right back into command and control mode where the government decided which sectors get gas and which don't. Others responded in their own ways. Pakistan introduced a 4 day work week to cut industrial gas use. Bangladesh cut supplies to fertilizer plants and power stations. Thailand ordered 2 decommissioned coal fired power units to restart. Japan and Korea, too, lifted operational restrictions on coal fired power. Across Asia, in fact, annual gas use in the power sector could drop by 60 to 65 billion cubic meters. That is, as prices went up, everyone didn't mechanically pay a higher price. They made choices on what to give up. Which brings us back to the question we started with. How long is it before gas markets return to normal? The honest answer is years. Even if the war ends immediately, the damage it caused will take years to undo. The repairs alone will take years. All the expansion projects that were to come up shortly will now be pushed out. 3 years ago, when Russia cut off Europe's gas, rich countries took the hit. They immediately bid up prices, paid whatever they had to pay, and absorbed the hit. This time, the worst of the shock has fallen on a different part of the world where countries can't simply outbid their way through. Where Europe paid, we have to ration. Now, coming to the tidbits. India's IIP growth likely slowed to approximately 2% in March, down from 5.2% in February, hit by weak manufacturing and energy output. Higher input costs, supply disruptions, and softer exports dragged activity, though government capex and infrastructure demand remain supportive. Coming to the next tidbit. India and New Zealand will sign a free trade pact on April 27th, aiming to double trade to $5 billion and attract $20 billion investment over 15 years. The deal gives duty-free access for Indian exports while protecting sensitive sectors like dairy. Coming to the final tidbit. Sun Pharma will acquire US-based Organon for $11.75 billion, marking India's largest pharma deal. The move will boost Sun's scale, expand its specialty drugs and women's health portfolio, and nearly double revenue with strong margins. That's all the news I have for you. Thank you so much for watching and see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.